Welcome to the deep dive. Today, we're venturing into a really fascinating and fast-moving area, artificial intelligence in financial services, specifically within emerging markets.
Right.
Our main guide for this is a compelling note from the IFC, and our mission really is pretty straightforward.
Yeah.
We want to understand exactly how AI is being used to break down those barriers, the ones that stop financial services reaching people and businesses who've been underserved.
It's a crucial area, definitely. I mean, for years, getting financial services to everyone in emerging markets has been a massive challenge.
Yeah.
And now AI, well, it offers this powerful new set of tools that might finally overcome some of those long-standing hurdles.
Absolutely. And, while AI as an idea isn't new, what's really driving this acceleration now is breakthroughs in machine learning. That's where computers learn from data themselves.
Right, without explicit programming.
Exactly. Plus huge increases in computing power, data storage is cheaper, and, well, communication networks are everywhere now.
Yeah.
So essentially AI, as our IFC note puts it, is about making machines intelligent enough to analyze their surroundings and then take actions to meet specific goals.
It's a good working definition.
And interestingly, a survey mentioned in the note found that something like 85% of financial firms are already using AI in some form.
Wow, 85%. That really shows how fast this is taking hold.
It really does.
Yeah.
It underscores the potential.
And that adoption rate makes perfect sense when you think about the specific challenges in emerging markets. You've got so many people lacking traditional ID or collateral or any kind of formal credit history.
Yeah, the basics are often missing.
Plus, it's just expensive to serve customers in rural areas or low-income communities. So AI starts to look like, a potential game changer.
Okay, let's unpack this a bit, starting with one key area where AI is already making a difference, analyzing new and, frankly, complex data sets. The note highlights how this helps make better credit decisions, identify threats more effectively, and even bridge financing gaps for businesses. Let's start with improving credit decisions.
Yeah, this is where the impact on financial inclusion can be really, really profound. Traditional credit checks, they rely on formal documents, financial history.
Stuff a lot of people just don't have.
Exactly. Especially women, people in the informal economy, they're often locked out of the formal system because of it.
Right. But AI, it offers a different path, using what they call alternative data.
Alternative data, yeah.
Think about, public records, satellite images, even
Satellite images, yeah, it sounds futuristic, but it's happening.
company registries, digital stuff like SMS messages, messenger chats. The idea is to build a picture of creditworthiness from these non-traditional places.
It's like you said, making people visible who were previously invisible to the banks.
Exactly.
And what's really clever is how different groups are applying this. Take Farm Drive in Kenya.
Okay, Farm Drive, what do they do?
Well, they've got this system where they collect data directly from farmers using just basic text messages.
SMS. Simple as that.
Yep. Things like farm location, what crops they're growing, farm size, assets they own, their activities.
Right, okay, and they combine that with other data.
Exactly. They mix that farmer-provided info with existing agricultural data like weather patterns or soil types
Yeah.
to build a much richer credit profile.
And they can predict repayment.
They use testing and data analysis to predict the likelihood of loan repayment. It's a smart way to use basic tech for, sophisticated financial insight.
That makes sense.
And they're not stopping there. Farm Drive plans to bring in satellite imagery to check crop health, use crop cycle data to predict yields, maybe even develop tailored insurance products down the line.
Wow, so it starts with credit and expands.
Yeah, it shows how these applications can evolve.
Okay, another example is M-Survey, also Kenya, right? Their thing is mobile surveys.
That's right. A mobile survey platform to generate consumer profiles in essentially real time, like constantly checking the consumer pulse.
And machine learning helps here how?
Well, the system learns as more survey data comes in. It gets better and better at spotting the key indicators for creditworthiness.
Ah, okay. Like refining the algorithm.
Exactly, which could mean lower costs and faster underwriting for anyone with a mobile phone.
Which is huge for access. Then there's MyBucks, operating in several African countries. Their AI, Jessie, apparently scrapes phone data. That sounds quite invasive.
It does delve deep, yeah. They analyzed data from a borrower's phone for the lending profile, and the results they reported were pretty significant.
Like what?
In South Africa, they saw an 18% drop in default rates between 2017 and 18 after bringing Jessie online.
18%, okay. That's noticeable.
It is, but and this is important, the IFC note cautions it's still early days. We can't just say AI solves all non-performing loan problems.
Right, responsible lending still matters hugely.
Absolutely essential. AI is a tool, a powerful one, but not a magic wand.
Okay, that's a really vital point. Let's shift gears slightly to the second application, identifying threats. Financial institutions, especially in emerging markets, are vulnerable, aren't they? Cyber fraud, money laundering.
Yeah, terrorism financing
Yeah.
too. Very vulnerable. And the usual tools, KYC, know your customer, AML/CTF, anti-money laundering, countering the financing of terrorism, they face big hurdles.
Hurdles like,
Well, lack of formal ID for many people, official registries might be patchy or unreliable. Sometimes there's just not much trust in government data.
and meeting those KYC requirements is critical, isn't it, for things like correspondent banking, remittances.
Absolutely crucial. Remittances are a lifeline for so many economies. So AI-powered compliance tech can really help here.
How so?
It can sift through massive amounts of transaction data super fast, spot weird patterns, link information that might seem unconnected, cross-check against way more databases.
Using more factors than the old methods
Exactly. It can significantly cut the costs of doing KYC.
and reduce false alarms. I imagine that wastes a lot of time.
A ton of time. McKinsey estimates maybe a 20–30% reduction in those false reports. But
There's always a but.
yeah, adoption's been a bit slower than you might think. Part of it is this black box problem.
Meaning,
The algorithms can be so complex, it's not always clear how they reach a decision. That makes it tricky for regulators to validate them.
oh, okay, I could see that. Lack of transparency.
That and the cost. For many smaller FSPs in emerging markets, getting this software up and running is just too expensive initially.
So cost is a barrier again.
It is, though the IFC suggests things like shared services models could help. Multiple institutions pooling resources to access the tech.
That makes sense. Economies of scale. And we also have the sheer volume of digital transactions exploding, right? Which means more risk.
Definitely more risk. Fraud, cyber attacks. A CGAP survey back in 2017 highlighted how system outages from cyber attacks really damage customer trust.
Yeah, if the system goes down, people get nervous.
Understandably. And while AI can help identify and manage these cyber threats, again, the cost of those advanced AI security tools can be prohibitive for many.
Okay. Let's pivot to another area addressing financing gaps, specifically in supply chain finance. This wasn't one I immediately thought of for AI.
It might seem less obvious, but there's huge potential. Global supply chains are incredibly complex,
Right.
and banks take on significant credit risk financing trade, especially across borders. The Asian Development Bank put the global trade finance gap at $1.5 trillion.
Wow, 1.5 trillion. That's enormous. Why is it so big?
Often, it's the high cost of assessing creditworthiness, complex compliance, especially hitting SMEs, small and medium enterprises in emerging markets hard.
Okay, so how does AI step in?
Its strength is analyzing the sheer amount of data generated within the supply chain. Machine learning can look at alternative data like production records, sales figures, payment histories between firms, shipment details.
So tracking the actual flow of goods and money.
Exactly. This allows for more tailored financing, better risk assessment, even real-time fraud detection along the chain.
That sounds much more dynamic than traditional methods.
It is. Take a company called TradeTech. They've built a platform using this kind of alternative data to help investors and originators negotiate, analyze, and manage trade finance deals.
And they've tried to make it accessible.
Yeah, their pricing is based on usage, not a big upfront fee, which helps lower the barrier to entry.
Smart. But there's a catch, right, depending on the SMEs.
There is. The note points out a key limitation. How digitized are the SMEs in the chain? If their data isn't digital and accessible, AI can't analyze it.
Right. So the tech is there, but the data needs to be too.
Precisely. The potential benefits in reducing structural costs are there, but it depends on the whole ecosystem digitizing.
Okay, let's move to the second big category from the note. Automating business models. The idea here is lowering transaction costs to serve more people with tailored products.
Exactly. Process automation using AI is key to making services more accessible and affordable. Think about customer engagement and service in digital finance.
Chatbots, basically.
Chatbots are a big part of it, yeah. Juniper Research estimated banks globally could save something like $7.3 billion in operating costs by 2023 just from chatbots.
$7.3 billion. That's huge. Are there examples?
Definitely. Bank BCP in Peru has one called Arturito using IBM Watson. It handles currency conversion, credit card payments, offers 247 support via Facebook.
Meeting customers on platforms they already use? Makes sense.
Yeah, figure 1 in the note actually shows the chatting with little Arthur interface on Facebook, and Banco Bradesco in Brazil also using IBM Watson.
What are their numbers like?
Massive volume. Around 283,000 questions answered monthly across 62 different products with 95% accuracy.
Wow. That scale and accuracy is impressive.
It really is. And think about the inclusion potential. Reaching people who can't easily get to a branch or prefer interacting in their own language via text.
And it goes beyond basic Q&A.
Yeah, MTN in Côte d'Ivoire is working with a company called Juntos. They're integrating AI support into their Momo digital wallet.
To do what?
To help users better understand the financial products available to them, they report something like 95% of their digital dialogues are automated now.
95%. That's very high.
It is. And the note makes a great point. Using chatbots and language processing to tackle issues like trust and financial literacy, that's still a relatively unexplored area with massive potential. Figure 2 shows an example interaction about loan eligibility.
Delivering personalized guidance at scale. Okay, let's talk personalized banking. Traditionally, that's been for wealthy clients, right? Because it's expensive.
Absolutely. High-touch service costs money. But AI and big data are changing that. FSPs are using them to automatically assess consumer behavior.
And offer advice.
Yeah, simple savings and basic investment advice, often for free. This robo-advice.
And that helps inclusion by making advice affordable for people with smaller balances.
That's the idea, lowering the service cost. Though widespread robo-advisor use in emerging markets is still mainly in Brazil, China, India.
Early days still.
Yeah. But look at Arthantra in India. They have a robo-assistant called Arthos.
Arthos. And what's their angle?
They're trying to counter that culture of relying on informal advice from family or brokers who work on commission.
So trying to offer more objective, data-driven advice.
Exactly. Arthos analyzes customer data, recommends mutual funds based on their risk profile, even offers monthly rebalancing options.
Interesting, but the question remains, I guess, do these robo-advisors actually lead to better outcomes than a human advisor?
That's a critical question. Needs careful analysis over time. And it's important to distinguish, between the chatbots doing customer service.
Like a Dorito.
Right. And these specialized robo-advisors doing automated financial planning and investment. Different functions.
Okay. The note then talks about more complex AI applications still being developed, but with big potential, like weather risk contracts for farmers.
Yeah, this is really innovative stuff. Addressing climate risks for vulnerable people, these contracts are basically insurance.
How they work?
They provide pre-agreed payouts if a specific weather event happens, like too little rain for too long.
And AI is crucial for this.
Absolutely. Companies like WorldCover use AI to analyze huge amounts of data, satellite data, weather station readings, soil data to accurately assess the risk of specific weather events in different farming regions.
Wow.
They're even looking at smart contracts using AI and blockchain to trigger automatic payouts through mobile money like M-Pesa.
So a farmer without a bank account could still get an insurance payout on their phone. That's potentially life-changing.
It's a huge step towards financial resilience. But the note stresses scaling these solutions is key. There's a massive insurance protection gap in emerging markets.
How big?
Something like $160 billion, apparently 96% of the global total. So scaling these innovations is critical.
Okay. Now, with any powerful tech like AI, especially in finance, we have to talk risks. Privacy, algorithmic bias.
Yes, critical considerations. The ICCR, that's the International Committee on Credit Reporting, they've flagged several risks with AI in credit scoring.
Such as?
Things like data inaccuracies creeping in, lack of real informed consent about data use, the potential for bias and discrimination getting baked into the algorithms.
Unintentionally, perhaps, but still harmful.
Exactly. And increased cyber risks because these systems are complex targets.
And the note mentions feedback loops can make these risks worse.
They can. If an AI model's decisions feed back into the data it learns from, it can amplify existing biases over time, create a cycle.
Right. There's also this worry about a winner-takes-all situation.
Yeah, the idea that early AI adopters who get big data sets and fine-tune their offerings could gain such an advantage that they dominate the market.
Which could reduce competition and consumer choice.
Potentially, though the note also suggests AI could foster new, cost-competitive tech suppliers, maybe leveling the field a bit.
So it could go either way.
It seems so, which is why government and regulatory oversight is going to be vital. to monitor for anti-competitive behavior.
And FSPs themselves need to step up.
Definitely. They need to hire people who actually understand this tech, ensure it's used responsibly, ethically.
Because the risks are real if it's done badly. Increased debt, lost trust.
Huge risks. Responsible lending practices, risk management guidelines like the ICCRs, they're more important than ever. FSPs need solid governance around data ownership, privacy, security, bias. It requires coordination.
And the note connects this back to the need for basic digital infrastructure, right?
Absolutely. AI in finance relies on having good digital financial services already in place, interconnected platforms, shared infrastructure, reliable ID systems. Governments and investors need to keep building that foundation.
Plus basic stuff like telecoms and power.
Can't forget that. Without reliable connectivity and energy, you just widen the digital divide.
And jobs. AI will impact jobs, won't it?
Inevitably. Some roles might be displaced, maybe customer care agents by language processing. But new jobs will appear in AI governance, regulation, maintenance. The big question is, where will those new jobs be?
And who gets them?
Exactly. Though the note does suggest some roles, like banking agents providing that human touch in lower income areas, might be less affected in the short term.
Okay, let's look at how we can encourage responsible AI deployment. The IFC has a lot of experience here, it seems.
They do. They've invested in or advised over 150 financial services providers since 2007, using tech like AI to meet the World Bank's goals ending poverty, boosting shared prosperity that's core to their mission.
Any specific examples of their work?
Yeah, Yoma Bank in Myanmar. They developed a scoring algorithm for loans to suppliers and distributors using payment and order data, their non-performing loan ratio. Below 1%.
Wow, that's impressive.
Very. And there was that early partnership IFC did with Ant Financial and Goldman Sachs in China.
What was that about?
It was $245 million in financing for a data-driven lending product aimed at women-owned small businesses.
Targeting a specific gap.
A huge gap. Most firms in China are MSMEs, but very few got traditional bank loans. Ant Financial used machine learning on online transaction data.
Not collateral.
Exactly. Assessing creditworthiness based on actual payment history, not assets, it made a huge difference to competitiveness. Ant's loan portfolio grew significantly.
So it worked. And IFC is also educating the market.
Yes, developing handbooks with partners like the MasterCard Foundation, contributing to guidelines with the ICCR, and creating their own guidelines for responsible investing in digital finance.
But are being adopted.
Endorsed by many investors and FSPs, including ones like Branch. These practices are crucial for maintaining trust and avoiding harmful lending.
Okay, so looking ahead, the takeaway seems to be that early AI applications are helping overcome those classic financial inclusion barriers in emerging markets: ID, collateral, credit history, compliance costs, cyber risk.
Yes, AI's ability to analyze new data and automate processes is making it commercially viable to reach more people. That's clear.
But we need perspective. Current use is still quite narrow, right? Lots of unexplored potential.
Definitely. Things like using AI for deeper financial literacy support, that's largely untapped. And we have to be realistic.
About reaching everyone.
Yeah. Reaching the very poorest, people in areas with poor connectivity, no smartphones, that's still going to be incredibly difficult.
So what's the role for investors and DFIs like IFC going forward?
Mitigating the risks is key. Adhering to those responsible investing guidelines, carefully monitoring the actual impact, NPLs, service costs, customer service, KYC effectiveness, and continuing to invest in that enabling infrastructure and human capital.
It sounds like a continuous effort is needed.
It's a long game. It requires vigilance, collaboration, and a real commitment to responsible innovation to get the best out of AI for everyone.
Okay, so let's try and bring this all together. Our deep dive today shows AI holds, well, immense promise for expanding financial inclusion in emerging markets. It can unlock new data, automate processes, break down old barriers.
The potential is definitely there, significant potential.
But as we've discussed pretty thoroughly, it also brings real risks. Risks that need careful management, strong governance, and a focus on responsible use.
Absolutely. It's about balancing that potential with a very thoughtful, ethical, data-driven approach to make sure the benefits are genuinely inclusive and sustainable.
And on that crucial point, maybe here's a final thought for you, our listeners, to consider. As AI keeps evolving so rapidly in finance, how do we proactively make sure its benefits really are inclusive? How do we stop it from accidentally making existing inequalities worse, especially for the most marginalized people, those who might still lack the basic access needed to even participate in this digital economy? It's a really complex and vital question, one we'll all need to grapple with as this technology continues to reshape things. Thanks for joining us for this deep dive.